Hi guys, welcome to Moneycontrol. I'm Karunya Rao and with me is Kayezad Adajania. He's the personal finance editor with Moneycontrol, and today we are here to tell you how to go about choosing the right ETF. Now, since the first time an ETF got listed on the exchanges back in 2002, today we have more than 150 ETFs out there to pick and choose from. So if one has to get started on that sifting and screening process, what's the way to go about it and how to know which is right for you?
Yeah, so Karunya, as you rightly said, the choice of ETFs have really expanded, and there was a time when there were only about 10, 15, 20 ETFs, so it was easier for people to choose which ETF you want to invest in. But today there are so many ETF choices, and across large cap, then you have smart beta ETFs, and then you have the same, you have different fund houses launching, a Nifty ETF, a Nifty 50 ETF.
And you also have bonds and gold.
Yes, bonds and golds have also come about.
Yeah.
So how should you basically approach your ETF investment is obviously a very pertinent question. So there are two ways of doing it, or maybe three if I may add one more. One is that you just don't want any fund manager risk. Okay, you want to invest in a very passive way. You just don't want any fund manager risk. You don't want to depend on a fund manager's call whether to invest in this stock or that stock or this sector or that sector, because funds underperform and outperform also in certain cycles. They go through different cycles. Sometimes you don't know whether a value cycle will perform well or a growth cycle will perform well, and then you have your indices running ahead of your funds in certain markets, especially in bearish markets and falling markets. So you invest in a very passive fund like an index fund or an ETF fund. You are saying that I don't want any fund manager risk. I will just want to do what the markets are doing. I will mimic the markets. If the markets will go up by 10%, I want my funds to go up by 10%. If the markets go down by 5%, I want my funds to go. I'm okay with my funds go down by 5%. But if the markets go down by 5%, I don't want my funds to go down by 25%.
Yeah.
So that's basically the reason why you go for a passive fund like an ETF fund or an index fund.
So it's basically a situation where you don't want to rely on an external fund manager to manage those investments for you.
So that is the reason why you basically go for a passive fund. So now there are two ways. Either you do passive funds and index funds and ETF funds all throughout, or you try a blend of active funds and passive funds, which means that though this is another way of investing in an ETF fund. So for example, for a fact, and we at Moneycontrol also have documented this for the past few years, that it's increasingly difficult for large cap funds to outperform their benchmark indices. Okay, it's difficult for large cap funds to outperform the benchmark indices. It's relatively easier for, let's say, a small cap or a mid cap fund to outperform the benchmark indices. So what do? You replace your large cap fund with an ETF fund. Okay, so as far as a large cap investing is concerned, you go for an ETF fund. But if it is a small cap or a mid cap fund, you go for an active fund. So these are broadly the two ways that you incorporate an ETF in your portfolio.
But is there a do's and don'ts checklist? And also, if you could tell us and our viewers about how to sort of understand whether I want to invest in an index fund vis-a-vis an ETF that also tracks the index. So how can I go about differentiating and choosing what's right for me?
So an index fund actually works like just any ordinary mutual fund scheme. You give them, the fund collects the money and then buys the securities as per the benchmark index, and then every day they do a rebalancing to make sure that the underlying portfolio of the fund is exactly in line with the benchmark index. So there is an active amount of buying and selling which happens in an index fund in the last half an hour of the market to make sure that the fund replicates the benchmark index. So there is a cash level over there, and because of that cash level and because of increased inflows and outflows which can happen on any given day, there could be a difference in the slight difference in the portfolio construct of the fund vis-a-vis the benchmark index, which means that the tracking error of an index fund could be a little bit high. Right, which is what you don't want. The lower the tracking error, the better a passive fund is. So an ETF is one level superior than an index fund because the way the ETF is constructed, it's a little scientific and I don't want to go into details of it, but the way an ETF is constructed, the difference between the portfolio construct and the benchmark construct is very, very minimal, which means the tracking error of an ETF is far lower or could be far lower than an index fund. The structure is superior.
Right.
The problem is that for an ETF you need a demat account, and not everyone has a demat account.
So you have to first open the demat
Correct.
account, and which is not the case, of course, with an index fund. But how can you track, how your ETF has performed, and what you said about tracking error? How Nifty has gone up or down, or how my ETF has gone in tandem with that. Is there a fact sheet, or is that a daily, monthly, periodic update that we can get?
You just need to keep a track of your ETFs on the website of fund houses, and keep a track of this figure called tracking error. It's very important.
Okay. It's easy to find.
It's easy to find, but it's there on the fund's website. It's not. I don't think it's readily very available on too many websites.
Okay.
But for example, you can basically go through every fund house, at least the funds that you have invested in, and keep a track of your tracking error. But rest assured, if you are investing in, let's say, a Nifty fund or a Sensex fund or a broad-based fund, then the tracking error is quite minimal.
Okay.
Because you're investing in the most liquid stocks of all. So
that way you know pretty much how you're performing.
Well. Yeah, but if it's a smart beta ETF where the portfolio is constructed in a slightly nuanced way and a customized way depending on the fund house's strategy, then yes, the tracking error could be a little bit high over there.
And how often is this tracking error updated?
I think once in a month. Once in a month. I mean, it's updated. I think on a daily basis also. But once in a month, once in 2 months or 3 months, you can keep a track of it.
Okay, that's interesting. So now coming back to what I said in the opening line, there are more than 150 ETFs out there. Most of them are mirroring pretty much similar indices or similar sectors or segments of the market. So how do I know which one to pick? Is there a checklist that I can follow?
You need to obviously keep in mind what kind of an ETF you're looking at. I mean, you just can't, as you said, there are 180, 200 ETFs out there in the market. You just can't say that, I'll pick the ETF which is giving me the highest returns. Okay, that doesn't work.
Because that could change.
That could change, and also because an ETF is not supposed to beat the benchmark index, right? So you will have like about 60-70 ETFs tracking the Nifty 50 index, and there would be very little to differentiate one from the other.
Right.
Okay, so how to go about it? That's that's always a perplexing question. What I would suggest is that first of all, you should need to decide which index you want to invest, what type of an ETF you want. Are you looking for a large cap? Are you looking for a smart beta? Are you looking for a gold? Are you looking for a bond? So decide the asset that you want to be, decide the strategy that you want. Like, for example, there are so many people who say that and we of course also say that have a Nifty 50 ETF, have a Nifty Next 50 ETF.
Right.
That's for that takes care of your large cap because you're covering your top 100 indices. And then for your small and mid cap in a flexi cap, you can have your flexi cap funds and actively managed funds. Okay. So keep a track. Select one after you decide your basket. After you decide your which vertical you want to be in. Take a look at your tracking error. The lower the tracking error, the better. Keep a track of your costs. The lower the expense ratio of the fund, the better. And generally, a good liquidity helps if your index fund, if your ETFs are liquid enough on the stock exchange. And that's a little tricky to find. I mean, you need to engage yourself with a financial planner, or let's say your stockbroker, because it's an ETF. So you have to buy your ETF through your stock brokerage firm. So do a little bit of groundwork. There are many ETFs out there, but ETFs are very, very illiquid at times. Most of the ETFs are very illiquid. Now, fund houses like Nippon, which had earlier acquired Goldman Sachs, which had earlier acquired Benchmark, which were the pioneers of ETFs. Our experience shows that they have a good enough liquidity for their premier ETF funds. Fund houses like SBI, Edelweiss. We know for a fact that these guys have HDFC. These guys have taken steps to ensure that there is liquidity, but you can't be always sure because there's always an impact cost on your ETFs on a bad day.
Is it the same sort of process when you're trying to invest in a bond ETF or a gold ETF? Are the ground rules pretty much the same?
Pretty much the same.
Okay.
Pretty much the same. A bond ETF obviously works a lot different than any equity ETF.
Yeah.
Globally, bond ETFs are basically very, very popular. But in India also, the popularity is going up slowly and steadily. Edelweiss has launched the Bharat Bond ETF, which is quite, I would say,
quite the talking point in the market,
and it's a very new kind of a product, and it has done well in terms of what it set out to be, but not many people know about Bharat Bond ETF, so the awareness is obviously low, and brokerages obviously don't want to sell these kind of funds because they don't get them too much of commission. They are very low cost products, but it's a good product. It's a good instrument to have. It's a good diversification tool also to have in your portfolio, and it comes with a slightly it comes with a tenure, that closed-end tenure, so it helps you plan for your yields, investments, or tenure depending upon the yield on the day that you are investing.
But can't you withdraw midway?
You can withdraw. It's an open-ended fund. Again, the liquidity is the question what I told you earlier.
Yeah. In fact, even for gold right now, gold is of course even trending everywhere as we speak. It's close to fresh highs. Gold ETF vis-a-vis gold SIP vis-a-vis buying digital gold or physical gold. How do they all stack up against one another? And does ETF form or ETF as a instrument to buy gold have any edge over the others?
It has an edge because when you buy physical gold, you have to actually store physical gold, so that storage is a problem. And most of the times people buy gold not to sort of store it as an investment value, but they want to wear it. So as long as you buy gold in the form of gold jewelry, and you buy it in a limited quantity, that is fine. But if you really want to sort of have gold as part of your asset allocation, and you have a view on how gold, where gold prices are, and from that, obviously, I'm assuming that you would have a view on when you would buy gold, when you would sell gold. It's always easier to buy gold in an electronic form like a mutual fund or an ETF because it's easier to store and it's easier to buy and sell.
And track.
Now, the second question is how to go about doing it. Gold ETFs is obviously the number one choice, okay, but you need to have a demat account, as I said. So if we don't have a demat account, there is something called as a gold mutual fund. Gold mutual fund is nothing but a gold fund of funds. It's an FOF which takes your money and invests everything in the gold ETFs. So a fund house would have a gold ETF and also a gold mutual fund within its stable, because not everyone would have a demat account, right? So and also so that's one advantage. Second advantage is obviously you can do an SIP. You can do an SIP in a mutual fund scheme. It's very difficult to do an SIP in ETF because there is no automated way of doing it. Of course, that will also eventually happen. But the the linking of your bank account and your mutual fund, so that money goes out of your bank account and into your mutual fund, the SIP mechanism that can be set in a mutual fund architecture. So which is why you need to have a gold mutual fund if you are really interested in doing an SIP. Otherwise, gold ETF is good enough.
Okay, well, there you have it. Bonds, gold and equities covered as far as ETFs are concerned. Hope this video helps you pick the right ETF according to your risk appetite and according to your preferred choice of asset as well. Thank you so much for watching.
1st February 2023, the Finance Minister Nirmala Sitharaman will present the last full union budget before 2024 elections. India's most awaited financial event comes in the midst of global slowdown, inflation, liquidity tightening, geopolitical tensions, and re-emergence of COVID-19. Will India look to fire up its manufacturing? Will India build a moat against global uncertainties? What will the budget have for the middle class? Watch the complete coverage of Budget 2023. Real-time analysis, expert takes all day on Moneycontrol. Log on to www.moneycontrol.com for more.